Thank you so much for joining. Give us a minute and we will start. Hi, Niket, you are there? Can you switch on your video?
Yeah, hi, Brijesh.
Hi, how are you doing? Your voice is echoing. Okay, perfect. So you have joined from two IDs, it seems, right?
Yeah, I'll just log it up.
Usilio echo ho raha hai. Perfect. Yeah. Perfect. I welcome you, Niket. How are you?
Good, good. How are you, Brijesh?
I'm doing well. Calcutta is witnessing the first thunderstorm today, and I was thinking that today could be a tough time with this Wi-Fi connection, but last 1 hour it's been fine. And so if for any reason, if I log out of the system, it's because of the thunderstorm. Please wait a couple of minutes and I will log in again. This is the message to you and all the audience. We could not see even a couple of feet from the window. It was so cloudy at around 5 o'clock in the evening.
Yeah. No, I can understand that. Not a worry at all.
Yeah. So can I request the audience to please welcome Niket from Motilal, and do mention your name and the city from where you have joined in. Let's see. Mr. Murthy, Jay Venkatesh, Anil Gupta, Sachin Sangle, Nasik, Maharashtra, Sunil Udaipur, Hemant Rana, Hyderabad, Uday Salamke, Mumbai, Varanasi, Punjab. So Niket, we have audience from all over the country. We have members from 378 locations, 1960 registered subscribers of Masterstroke, and we are growing every day. And they have been very supportive to Masterstroke, and we have been doing these webinars for the last 2 years now, and we get a good audience, and so it's going to be a good day.
Yeah, we look forward.
Yeah, Ashfaq, Chetan, Naresh, Nitin Chandra, Aurangabad, Hyderabad, Surat, Tamil Nadu, Coimbatore. Fantastic. Thank you so much, all of you, and I hope this program will benefit you all. I did my research on Motilal Midcap Fund, and and I'm going to ask some interesting questions to you, Niket, today. And I hope to find my answers, which I'm looking for, and also I hope the audience will get their answers to the many questions they have in their mind. So what's happening? What's new at Motilal and at Niket's point of view? What do you think about the current markets, Niket?
Yeah, so Brijesh, thanks for having me here, and thanks everyone for logging in on a Saturday evening. I think our view on markets have been slightly more conservative at this point in time, and that's also reflective in the kind of portfolio that you've constructed. I think last couple of years have been a dream run for everyone in equity markets, whether it's mutual funds, retail investors, and HNIs, or foreign institutional investors. A large part of that was obviously driven by the quantitative easing that we've seen in the United States, the printing that happened, and now we're seeing the reverse of that happening. So we clearly believe that the next 6 months to 1 year can be a year of extreme volatility. And I won't be surprised if we see correction even from current levels. So you might have markets going up at some point of time and markets going down some point of time. But I think the period of last 2 years that we saw generally of earnings upgrades and stock flying off and valuations expanding, I think those things won't happen at this point in time. So our view at this point in time clearly is to be slightly more on the conservative side. We believe there are multiple headwinds to this market, and with Fed already announcing the plans to taper and shrink the balance sheet, we are in for a kind of a stormy ride the way it is in West Bengal right now. So my sense is the other point which I always want to highlight, and I keep telling everyone, is while these are corrections which will come in the next 1 year, please use this as an opportunity to invest in equity markets. We have seen bigger corrections than this in equity markets where the world was shut, and people who invested in that lockdown actually made tons of money or money of their lifetime, right? So I think the next 1 year would give you a very interesting opportunity to invest in equity markets, depending on your risk profile. And I think one should use that opportunity to the fullest. But to answer your question, I think I would be slightly more conservative on equity markets and slightly more cautious. There are multiple headwinds on inflation, Fed doing a lot of action on the US side as such. But yeah, I think we run a portfolio, so we have to perform at all times.
Okay, so because this is interesting. When a fund manager says that you are conservative, what do you mean by that? Because mostly you are already 95% invested. You don't do anything. Mostly you don't churn the portfolio as much. So how will you define the word conservative when you don't take any action?
Yeah, so while we do take some actions at times like this, it's not that we just completely inactive at this time. These are the times to really capitalize and be ahead of the curve. We've done that in the COVID era, and we've done that again right now. So I think to answer the conservatism cycle would obviously be, if you look at last 2 years, were cycles of earnings upgrade across the board, right? Irrespective of whichever sector you look at. What we are seeing is, a cycle of earnings downgrade coming to begin, right? So we've seen this as a first quarter of some set of earnings downgrade, and I think you will see that acceleration happening in the next 2 or 3 years. Inflation obviously is one important factor. The other important factor is always some at the margin demand slowing down, right? Primarily due to inflation, right? It's a virtuous cycle to that extent. So to that extent, I think, while demand comes off, margins come off, you will see interest rate going up in the system. So companies with high debt tends to pay higher interest costs. So to that extent, your bottom line growth tends to be under check at this point in time. So our view is that we might see some bit of earnings downgrade on the overall market side of it for the next couple of years, specifically this year itself. And once that gets readjusted, I think we are in for the next round of rally in the equity markets again.
All right. So I want to congratulate you because, I saw the performance of Motilal Midcap 30 and at Masterstroke platform only. So we have a robust MF research platform, and I've been clicked on the snapshot of all the midcap funds. I was very positively surprised, I must say, that Motilal 30 was right on top for 1 year performance. So I want to congratulate you. And what do you have to say about this? How did you do this?
So I think it's a multiple things, right? I took this fund 2 years back, and 2 years back, if you look at it, our performance wasn't so great. So we got impacted in the COVID period. The couple of months that the market corrected, we got impacted because we had very high banking exposure. Because prior to COVID, banks were doing extremely well, right? And COVID came as a surprise to everyone. And post that, I think we rejigged the portfolio given the environment of COVID. We went overweight on IT. We went overweight on multiple other sectors like banking, cement. All of them benefited us. What we also did is in the last 2-3 years, while our sector selection was right, within that sector, our stock selection was absolutely phenomenal, right? So just to give you some sense that within auto as a sector, which has underperformed in the last 2 years, we actually focus on auto ANGs, which did extremely well for us, right? So identifying the sector, further below that, identifying the right stock within that sector is extremely important, right? So while we identified the right stock, we got them right at the right price, and we exited them when in the markets in the month of December and January. So we went from extremely overweight on IT to extremely underweight on IT. We went from extremely overweight on cement to extremely underweight on cement. We exited metals, so on and so forth, power and all of that. So what we essentially did is most of the IPOs that we have got in terms of allocation, we reduced that allocation as well in the month of December, January, because we could clearly see some of these headwinds coming up in the markets. And also valuations were crazily high, right? It's very tough to justify those kind of valuations. And we've historically seen that, those kind of times don't sustain beyond a period of time. It course corrects, and there has to be mean reversion at the end of the day. So I think keeping those in mind, we kind of rejigged the portfolio more like in the month of December, January. We went to, I think, about close to, at one point of time, we were about 10% cash, not by design, but, as an outcome, because we couldn't find any stocks to invest, primarily because valuations were very, very high. And, in this correction, we've got so many ideas to invest now that we're now down to about 2.5-3% cash. So the idea is that, we have to identify the right sector at the right time, and within that sector, the right stocks. I think both of them is a very tough task as a manager to manage all the time. But I think last 2 years we've been able to manage, and we hope that we should continue to do that in the next 2-3 years. So the idea is to be ahead of the curve all the time. Before the market fell down, before the IT fell down, we were underweight. Well, most of our peer sets were overweight to some extent. So you have to be ahead of the curve at all points of time.
Wonderful. So निकेत, मैं आपसे ये पूछना चाहता हूँ, प्लीज अलाउ मी, म्यूचुअल फंड डिस्ट्रीब्यूटर और इन्वेस्टर को क्या देखना चाहिए, 1 साल का रिटर्न या 3 साल का? बिकॉज आप 1 साल में नंबर 1 पे हैं, और जब हम 3 साल का रिटर्न देखते हैं तो आप मिडिल ऑफ द पीयर ग्रुप में हैं. लेट अस से दे आर 20 फंड्स, सो यू आर इन द 10th और 11th पोजीशन. तो मेरा क्वेश्चन ये है कि हमें इन्वेस्टमेंट 1 साल देख के करना चाहिए, फंड हाउस को देख के करना चाहिए, फंड मैनेजर को देख के करना चाहिए, या 3 साल के ट्रैक रिकॉर्ड को देख के करना चाहिए? क्या ओपिनियन है आपकी?
No, absolutely. I think it's a very valid question. I think one important point which I always like to see is that one should not look at a 1-year performance and invest, right? And although I'm saying that because today I'm actually in a favorable position to say that, but I think from an investor standpoint perspective, keeping their interest ahead of everything else, I think we should clearly look at more like a 2 to 3 year kind of a performance, right? 1 year can be very good for anyone at any point of time. But for us, even 2 years has been extremely strong. On a 2-year basis, we are second ranked today. On a 3-year basis, we are still at 9th or 10th rank, which you're absolutely correct. The reason is, if you look at 2 years back when I took it over, we were the last rank, 24 out of 24, right? So because of our 2-year performance being so good, our 3 years also moved up to the 10th position. Now, if we continue to perform the same way for the next, hopefully in the next 3 or 4 years, we should be able to give you a 5-year or a 7-year performance to be the first quartile or the first or the second rank as such. So that's the endeavor as such. To the question that you asked about how should one really look at mid-cap funds, or how should one look at picking a fund as such. So I think a few things are extremely critical for us, right, in-house, and that's how even our appraisals happen, right? One is, I think, the PAT growth of the portfolio, right? At all points of time, the stocks that you're buying might be high quality in nature, which is very essential, but they also need to have very high growth, which is what QGLP, essentially our philosophy, stands for. So I think PAT growth of the portfolio is extremely important for us. The second is the quality of the portfolio, right? And how do you define quality of portfolio? Because quality is such a subjective word that, you can have multiple meanings of quality, right? So for us, quality really means ROE of the portfolio, right? So what is the ROE of each and every stock, or, blended ROE of the portfolio? I think that tends to be the second most important vector for us. And third, for me personally, is the size of the fund, right? So if you look at a lot of funds might be very, very large in size, and for them to maneuver is so difficult versus a fund of our size, which is about 2,800, 2,700 crores today. It's slightly more easier for us to maneuver, buy and sell stocks easily. And at some point of time, when we go to 10,000 or 12,000 crores, you might not see the kind of alpha that we've generated at that base, right? Generating a 20% alpha at that base is a bit of a task as such. So I think we are able to generate the superior alpha today primarily also because of size, which actually benefits us to that extent compared to most of our peers where the size is very, very large. So I think these are 3 major things that we essentially look at. And the fourth is very, very subjective, which is the portfolio extremely well balanced and not skewed to one particular sector disproportionately, right? Because that essentially will also mean that while a particular sector will do very well, and that, at the same time, the portfolio can do very well, but that portfolio inherently has significant amount of risk in case of any downturn. So I think keeping those 3-4 things in mind, I think, one should really look at investing in any funds.
Okay, so you made an interesting point, Niket. आपने बोला कि मोतीलाल is at 2,700, 2,800 crores. It is difficult to maneuver big assets in a mid-cap fund. I also did this research.
Yeah.
And of course, so I found out that while 1 year you are in the top, when I see 5-year return, some of your peers, like, let's say, I can name them because of publicly available data, let's say Axis Midcap or a Kotak Emerging, have 15,000, 20,000 crores of assets, also 10,000, 15,000 crores. Sure. And they are ranked number 1, number 5. They are in the top 5 in terms of performance. So how conclusive is this, that on a small cap or a mid cap mutual fund portfolio size does matter or doesn't matter?
No, so that's an interesting point that you highlighted, right? So I think if you look at some of the names of the funds that you mentioned, at some point of time were also very concentrated in nature, right? So if you look at someone like an Axis Mutual Fund, which you mentioned, they also never used to have so many stocks. Obviously, they used to have much more stocks than us. We used to typically run a 27, 28 stock portfolio. They at some point of time were close to about 35 to 40 stock portfolio, right? And obviously now they've kind of diversified a bit more, post-COVID era as such, because the market was much more broader in terms of performance. Having said that, I think two things happened, right? Once the size of the portfolio goes up, right? By design, you have no option but to hug the index to a larger extent, right? Just say 70-80%, you will hug the index, and balance 20%, you will take an active call on different stocks that you like. In that kind of situation, the alpha typically is positive 300 basis points or negative 300 basis points, depending on how that 20% would have performed in a market like this. For us, I think the interesting point is that we actually believe that India is a market which is extremely under-researched on mid-caps and small caps, right? And I can't say the same way for large caps, but for mid-caps and small caps, there's a huge amount of opportunity for active fund management to kind of come and demonstrate disproportionate alpha generation. A small fund like us can generate you a 18-19% alpha, which is there today on a one-year basis. But I really doubt a fund of that size can generate an alpha of 18-19% in any year for that matter, right? So for us, what is important today is, as the size grows, the sustainability is extremely important for any investor. And that sustainability does come because of, number of stocks increasing, hugging of stocks to the index and becoming more closer to the index. Today, at this point in time, if you look at our fund today, we are 75% active ratio and 25% hug to the index. Most of our peer sets would at least be 60 to 70% hug to the index and about 30% or maybe say 25% or 30% active ratio. So we are the other way around, and that benefits us over the medium to longer term, depending on how well are you able to manage your portfolio environment and all of that. So I do believe that size at some point of time gives you that disproportionate alpha, provide the fund manager is right. And we have demonstrated that this year, last year, in prior to COVID also, we had years where we had 16-17% alpha, right, in a normalized environment. Now, if another COVID had to happen, obviously, I don't know how the portfolio would shape up, but essentially in a normalized environment, we believe we have potential to deliver at least a double-digit alpha on a year-on-year basis in a normalized environment kind of thing. Primarily because size does benefit to some extent, but I think once the size goes up to 10,000, 20,000 crores, the alpha percentage kind of really comes off because you hug the index slightly more than what it is, because you can't take larger positions on 25 names in a mid-cap stock when the size goes up.
So, Niket, allow me to be playing a little bit of devil's role, because my objective today is to get answers which mutual fund distributors are looking for, and to decide for them to help कि कौन से mid cap में डालना है, क्यों डालना है, कैसे डालना है. So they will take their independent decisions. So I want to take the best out of you to get those answers. So आपने जो बात बोली उसमें मेरे दो points हैं. First, if you think that size will become when you get bigger, it will become difficult for you to provide more alpha, and if that be the case, returns will come down. Do you intend in a future date to restrict? What is the ideal sweet spot of AUM, and will you close the fund to make it, continue to deliver that kind of alpha? If your philosophy is that size does matter, and so we like to keep small, and if that be the case, how you as an AMC will grow, because you cannot have multiple mid-cap funds as per SEBI.
Absolutely, yeah. So it's a fair assessment. I think the sweeter spot always is in the range of 1,500 to 4,000 crores in terms of size when you look at a mid-cap fund today. Because the mid-cap category by definition is not the earlier definition that we used to have. Mid-cap by definition today is companies with market cap of more than 10,000 crores and less than anywhere between 40 to 50,000 crores in that bucket, right? That's what we define as mid-caps. And that's how AMFI defines it as well. So I think if you have a fund of that size, and if you have a philosophy of a house which is very focused on quality, and if you have a slightly more dynamic management of the fund from an active standpoint perspective, I think performance has to come, right? And that kind of performance does come. On the point that you highlighted, at what AUM does the performance starts coming off from a percentage of alpha, from an alpha percentage basis, I think anything about 10,000 crores, right? You might, to get a double-digit alpha on a sustainable basis, becomes a slightly tougher ask. and then you really move to a single digit kind of an alpha number, right? Because at all points of time, or the portfolio is never perfect. Although we as fund managers want the portfolio to be perfect at all points of time, the portfolio is never perfect. At any point of time, you will have some stock which will always surprise you negatively, right? And if you run a concentrated fund at that kind of size and scale, it becomes slightly more difficult to kind of really manage the alpha asset, because any one wrong call and the alpha can really vanish. So in line with that, we are also moving in that direction, because we do believe that this portfolio is going to move to a 10,000 crores in the next 2 to 3 years. So we have also applied recently to the regulator to remove a 30 stock barrier and kind of really look at a slightly more wider horizon as we kind of really become larger in size.
All right. And the second follow-up question which you said is that you have a hug ratio of 25%. And 75% you are playing active. Now, from the distributor perspective or from the alpha perspective, while you are benchmarked with the index, you're not buying index stocks. Well, yes. That is a fair assessment that you can go anywhere in that SEBI directed list or unprotected list of mid-cap stock category. That's fine. But do you think that's the thing a distributor should look at in terms of index hugging? Because that's not the true barometer. If you are having only 25% of the stocks composition of index and you are being benchmarked with that index, how should I judge the performance of a fund manager? ऐसा नहीं होना चाहिए कि जो स्टॉक्स आप ले रहे हैं ऐसा कोई इंडेक्स बने, जस्ट हाइपोथेटिकली, कि आपने अपना एक 50 स्टॉक का इंडेक्स बनाया है या 50 स्टॉक है, जिस स्टॉक को आप ले रहे हैं उसके रिलेटिव परफॉर्मेंस ड्यूरिंग द ईयर क्या थे और उसके अंदर में क्या रिटर्न आई. So this hug ratio of 25 and 75, let's say, what is your assessment? A mid-cap fund with a 70% hug ratio delivers 5% alpha versus a 25% hug ratio fund delivering 8% alpha. Where should a distributor go and why?
So fair question. I think a fund which is hugging the index by about 75 or 70% and 30% active tends to give you about 4-5% alpha, assuming the fund manager is extremely dynamic. But I think the other way around is maybe the alpha would be more likely double digits, in my opinion, because when you take such a high active ratio call, you tend to get it right. If you tend to get it right, then it's you tend to get disproportionate alpha for that. The second point which I wanted to highlight here is that for us, we don't think that we want to have 75% active ratio. It's not a decision made in house that we will have a 75% active ratio. No, that's not the way we think as a house. As a house, we think that we want to look at high quality companies. We want to own them over the medium to longer term, and we want to essentially own companies with high quality and growth. Now, our approach to stock selection is extremely bottom up, right? We do have a very strong bottoms up approach on stock selections, right? So whether the stock is an index, so I compulsorily have to buy, the answer is no, right? If I have a negative view on a stock which is a part of index, I really don't want to buy that stock and impact my unit holders, right? I rather buy 15-20 stocks which I believe, after doing the detailed amount of research, that these are the stocks which will do extremely well for me over the medium to long term, and which benefits my unit holders and benefits me as well, because most of my saving also goes into my fund. And in fact, my entire, the listed company's capital also is in my fund. Then I think our alignment is very clear that we have to find, the stocks which can essentially generate disproportionate returns over the next few years. So that's how we generally think. We think very bottoms up. I think the outcome becomes a situation, where active ratio tends to move very high, because a lot of stocks in the index are something that we just don't like. It doesn't pass on our filter list as such from a quality standpoint perspective. If you look at the data, right, and it's extremely interesting, right, that the data suggests that if you look at the last 15-20 year data, the best performing category is actually active mid-cap funds in India, right? So mid-cap funds in India would have generated highest amount of returns. In fact, if you look at every 100 rupees that would have invested, say in 2004, right, you would have actually generated 8-time returns in a large cap fund. You would have generated 9-time return in a small cap fund, and you would have generated 11 times return in a mid cap fund, right? And that is a public domain information, and one can calculate that. So I think the data clearly suggests that mid-cap funds do extremely well from a return standpoint perspective, as well as from a risk standpoint perspective. A company which is more than 10,000 crore market cap has at least arrived somewhere in life, right? And it's not a fly-by-night company in that sense. Has capability to handle and withstand multiple negative shocks in the economy if it comes like a COVID kind of a situation. So I think mid-cap funds do very well, followed by mid-cap index. And I think the worst performing category is actually the small-cap index, right, by design. So I think for us as managers I think it's a very sweet spot to own a mid-cap fund. And mid-cap index is actually in a very sweet spot. And data suggests that over the longer term, the maximum wealth is generated in the mid-cap side, not even in the small cap, not even in the large cap. In fact, for large cap funds, the worst performing category is active large cap funds, right? Only 35 to 40% of active large cap funds would have outperformed over the 10-year to 15-year period, right? But that's not the case in case of small cap or mid cap. Almost 70% of funds over the longer term would tend to outperform the mid cap and small cap index, right? Because just that the index itself has so many stocks which are not worth of buying into a portfolio from a longer term standpoint perspective. So that is why we do look at index, we do look at stocks in the index, but for us, the bottoms up approach is more important. We have to buy the right quality stocks with very high growth. And essentially an outcome of that is, even if that outcome is 100% active issue, so be it. We are essentially here to buy the right stocks and generate returns for investors, rather than looking at what is the index composition and so on and so forth. I think we really don't, we do pay some attention and we are cognizant of it, but it's just that, we will not go and hug the index just because, a stock is 3% weight in the index or 4% weight in that index.
All right. So just a small correction here. Vishal has mentioned, surprising that small cap category is the worst category. I just want to take your opinion because I checked up today morning. Yeah. Small cap is actually last 10 years, if you leave out thematic, is the number one category, followed by mid cap. Of course, they're very close to each other. Mm-hmm. Last 3 years, 5 years, 10 years return, Vishal, small cap index for some reason has given the highest. When I'm saying small cap category as a whole, the mutual fund category as a whole is one notch above the mid cap. The best is probably the sector fund, technology sector fund is the best over the last 10 years, global basically. And last 3 years, basically auto, 5-year auto is the best, and 3-year banking is the best. But overall, small cap has done well. But we'll come to that later. Niket, my next inquisitiveness is to understand that you run a very focused fund in the mid cap category, only 23 stocks, and your top 5 holdings is almost 40%. What if it goes wrong? What kind of damage it can do, and what is this risk worth taking?
No, for sure. I think it's a question that we keep asking to each other every day. That is it worth taking? But I think when the fund is about 2,700 crores, I think it's worth taking it, right? And provided that you do significant amount of detailed work on a particular name over the medium to longer term, and your domain understanding of that company is so high. Obviously, there are external shocks which can impact any company within your portfolio. But if you get the right stock, as I said in the beginning, right, you got the sector call right, the stock call right. Yes, if the stock call goes wrong, then the damage can definitely be there. But typically, our view is that if you get one stock wrong within that, the top 5 stocks, we still believe that the balance 4 will take care of us, right? But if we get all of them 5 wrong, then yes, then it's doomsday, right, for us. Then I think it's a job it's a job not well done for us. And I think we do believe in that the kind of research that we do, the kind of time that we spend on the ground, and the reason why we are so much ahead of the curve is primarily demonstrated over the last 2 years in our stock selection capability. So we believe that if you get a good stock, and provided that you're extremely optimistic about the future of that stock, I think we should have disproportionate allocation on that particular name. Now, some of the allocation that you see in our portfolio is also because the stocks have become 4 times, 5 times, and they're not falling in this market, right? So that percentage of mark-to-market gain also does play a role. And we at some point of time are kind of, from a risk management perspective, have to tweak it down, right? So we do that exercise on a regular basis. But yeah, I mean, if we kind of get more number of stocks, we're happy to kind of diversify the portfolio. But I think, as I said, right, once the size kind of really moves up, we need to do that. And that's what we are moving in that direction. Because as the fund will grow now, we need to have more number of stocks in the portfolio and diversify it slightly much more. So I think over the longer term, for sure, that's a game plan for us. But I think for now, I think we believe the stocks that we own essentially, continue to give us superlative results in terms of PAT growth, ROE of the portfolio, quality of the companies that we own. And we're fairly comfortable with some of these names that we own in our portfolio today. So that's how we are positioned. The other thing that we also focus as a house and as an individual, I do believe I don't want to own stocks where the drawdown is very, very severe, right? So we look at companies where, much more structural growth is clearly imbibed into it, rather than companies where earnings can collapse by 50%, which is, any commodity names that you see, any cyclical names that you see. So our allocation to some of these cyclical sectors and names at all points of time will be very, very low. Right, the ROE of the portfolio is about 25%. If you look at the debt in the portfolio, is virtually zero. We don't like to buy companies with very high debt. Most of our companies don't have any debt. Most of our companies will throw significant amount of free cash flows. So we do believe that from a drawdown perspective, unless something really materially goes wrong, we should not see any significant drawdown in. It's like, TCS, can it go down 50%? I don't think so, right? Given the quality of profile that TCS has really built in, I really don't think those kind of stocks can really go down. So I think most of our stocks that we have, I think are from a quality standpoint perspective, from a cash flow standpoint perspective, and from a quality of management standpoint perspective, are right up there. And that's why if you look at in a good market, we did very well. In a market which fell down again, we did very well, right? So we have to perform at all times, but I think we've been able to manage both the cycles disproportionately well.
Great. So my next question is the valuation. What is the right valuation? When you talk about large cap fund, Nifty's long-term 20 years fair P is around 17. Cap stocks, Motilal 30 has a P of 57. Now, fund manager will say that it's because of the growth potential of these companies.
Yeah.
My question is, what is the fair value of a basket of stock? One stock can do extremely well, but with a basket of stock having a 57 multiple, how fair is that? Number two, at some point of time, this 57 has to come down to 47, 37, 27, or 17 to say that, the premium is now over and there is no growth left. Or you will continue to change the portfolio in such a way that every time you are lucky enough to buy good companies with a very strong future growth, and your P will continue to be 50.
Sure. So no, I think, yeah.
So what is your assessment from my perspective as a distributor? Is 57 cheap, expensive, and how should I look at? And the growth, so it's a 25% growth company. So at what level, 3 year, 4 year, do you expect it to come down to 20, 25, or it is fair enough at 40 also?
No, that's a very fair question, a very fair assessment, Prichesh. I think two things have important, when we look at these numbers, and I think, internally also we bisect and dissect these numbers into multiple parts. I think the multiple of 57 or 59 that you mentioned is absolutely correct. The reason why that multiple is higher, because we have some of the stocks in our portfolio today where earnings was disproportionately impacted in the last year because of COVID. Say we have a VIP bags, right? And virtually they had no sales last year, right? We had Phoenix Mills in our portfolio. They had no major profit because mall itself was shut for almost 3.5, 4 months in the last year, right? So what happens is we should look at some of these names from a normalized earnings perspective, rather than looking at these names from a current earnings perspective, because the current earnings are not the true reflection of the business, because the business itself was shut for 4, 5 months, right? If you look at, so what we do is internally we do have a sheet where we basically put that what is the normalized earnings of the portfolio, right? And what kind of EPS do we generally think these companies will generate in the next 1 or 2 years? In that matrix, for us, the portfolio is at about 28 PE today, right? For us, right? On a forward basis. And the reason why it is at 28 PE, which obviously is still higher than the index, because index is not at 28 PE, right? Index is far lower than 28 PE, is because the PAT growth of the portfolio is 45%, right? Now, when you have a 45% growth of the PAT growth of the portfolio, then I think, you're still buying a particular company or a particular sector, or the entire portfolio is still available at half peg, right? You have a portfolio which is going to grow at 48% and the valuation is 28 times. Right? And historically, we've seen, and this is what even Ramdeji's wealth creation highlighted, that whenever you buy a sector or a stock or a portfolio which is less than 1 peg, the chances for you to make money is disproportionately high. So I think if you dissect, and if you take out some of those aberrations, you would actually see that, the 58 would actually move more likely, I would say, to close to 38. or 37. And on that, if you take a 45% growth that you were assuming, it would be about 27 kind of a number as such.
Well, I think that's a very good point. I think it's a very good takeaway. And in terms of, not to look at an objective one single number of 57, we also have to probably have a system where you can publish data regarding the portfolio peg ratio. When you look at only on one data, you get confused. So are you buying 57 time multiple, or there is something more to that? So, okay, that's a fantastic point. And I will request the audience, if you have any question you want me to ask or Niket to answer, please put it in the Q&A box, and we'll try to take up a few questions during the program or after my questions are over. Niket, now I have been into the mutual fund industry for 20 years, and I see a very strong aspect of mean reversion. And when I see some of the fund houses and fund schemes, sometimes I get a feeling that if I every year on 1st of January or 1st of April or whatever date on a fixed day, if I just sell my winners and buy the losers, of course, losers doesn't mean that the worst performers, but good fund houses, good schemes. So by filtration, there are 44 companies. So let us say we go for the top 10. My sense is that, if you simply sell the last 1 year winners and you buy the last 1 year not so good doers, your portfolio will actually do very well. And this rationale is very well, witnessed. And I can give some names also. You take any name for that matter. Motilal FlexiCap, let's start with that. 2018, number one performer. 2019, 2021, bottom of the table. You take about Mire, the flagship schemes. Now, if you see the last 6 months, 1 year performance, not doing very well. From top of the chart, number one, many of their schemes are not in the top 10. You take Axis, they were number one, and suddenly they are nowhere in the picture. You see HDFC, sometimes they are top of the chart and bottom of the chart. So this mean reversion, do you think is a very strong concept? And if it is it time to sell when I sell, is it time to redeem Midcap 30? What's your answer?
I think Brijesh, I think it's a very, very sharp question. And I think, hats off to you to, really capture it so nicely. And I think a 20-year experience really comes here. I think, there are two things to this aspect, and I have very strong views about it, and happy to kind of listen to your views as well. If you keep a portfolio static, right? If I buy a portfolio of 20 stocks in my portfolio, and that portfolio remains static, right? Say HDFC, all the large cap names or mid cap name, whichever portfolio you want to look at it, right? And if that portfolio does very well for 2 years, and I don't do anything with that portfolio, right? Then I'm calling for trouble, in my opinion. The reason why I say that is historically cycles were a little more longer. Off late, the cycles are more shorter, and they're very fast. We don't like to sell a stock within 6-9 months, right? Essentially, we bought IRCTC at 1,400 rupees. We had to sell at 6,000 rupees, and it happened in just 5 months. And we don't sell that way. As a house, that's not the philosophy. But what happens if the stock goes by 4x? We never thought it would double in, like, our opinion was it'll double in 3 years. But it went 4x in just like in a matter of 5 months, right? So we had to take action. So the point that I'm trying to highlight to you is that if you keep a portfolio static, and I'll take an example of my own, other fund that you highlighted about, the FlexiCap fund. We had so many winners in that FlexiCap fund, right? If you look at Eicher Motors, if you look at Maruti, and there are so many winners that we had, right? What we did essentially, to some extent, we never exited those stocks at those higher levels. We just hold on to it, right? We said that, okay, these are great companies, etc., etc. A margin of a particular company is moved from 15% to 32%. It will go to 40, it'll do this, it'll do that. So when the times are really good, the valuations expand, I think that's the best time to book profits, right? And that's exactly the same thing that we've done, at least in Midcap 30, right? And that's one of the reasons, as I said, right? We did so much rejig in the month of December. If we wouldn't have done the rejig, Brijesh, we would have been down massively this year, right? If you just take that December fact sheet and just replicate it today, we would have been impacted dramatically, right? So I think it's very important to keep some churn in the portfolio, right? And in a time like this, the churn can move up, so be it. But at the end of the day, you have to look at the NAV and unit holders, returns to be at the primary focus area. So if you don't churn, then that mean reversion does happen. And most of the cases where you look at the mean reversion happen, essentially the portfolio would have looked very, very similar in the last 1 year to what it is right now. There would be 10-15% difference, that's fine. But essentially you need to have slightly more higher differentiation in the portfolio if the markets have really gone up like a tracer bullet, and you have to change the portfolio. We have changed our portfolio by I think close to 35 to 40%, right? And if the market collapses another 25%, we will again change it by another 35 to 40%. We will go very aggressive on beta, right? And we basically saw this as a global meltdown coming up, and we said we will focus more on domestic names. So our consumer allocation, which was underweight, is gone massively overweight today. And why do you buy consumer names at these times? Because it gives you a lot of stability, right? And you can forecast and foresee some assumptions you can make of the domestic economy, which is so strong. But you really don't know what's going to happen globally. If I buy something which is so much dependent on global markets, and anything happening globally can impact the financials, then I'm really asking for trouble, right? So I think the important part is that in a time like this, when you really think there are headwinds, you obviously maneuver your portfolio. And in a time like this, when you think that markets have become very cheap, and for example, ICICI Bank going to $500 or $400, there's nothing to think about. Or Bajaj Finance going to $3,500, nothing to think about. You just have to go and buy everything possible you can. So I think one has to really be very nimble on that side. And if you don't change your portfolio, which is what exactly happened with FlexiCap, the stocks are extremely high quality, but it's just that we never sold it at the right time, and we kind of really took the entire drawdown of that stock for the last 2-3 years, right? And essentially, we may not made any returns on some of these names, right? Now, the assumption can be that we will make returns on these names, right? And hence the portfolio will again come back, which is again to your point, right? A portfolio which is down and again at some point of time comes back. So over a 5-year period, right? You might have 2-3 years of very bad performance and 2-3 years of good performance if you keep a portfolio which is very, very static, right? But what happens is your portfolio, when it's doing very well, no one really wants to tweak anything. When the portfolio goes on, everyone suddenly starts doing so many action around the portfolio, and that damages the portfolio even more, right? So the idea is that you should, like what I do essentially, I make my own, earnings model. I meet companies, I go on the ground. I'm like completely hands-on. I mean, by designation, I'm a fund manager, but at heart, I'm an analyst. Right. So you have to be an analyst, right, at all points of time, because for almost 14-15 years, I was an analyst. So I really know at what time you have to really go and sell a stock. And when the valuation is really, gone through a crazy level, you have to really go and essentially book profits, right? And although you might lose another 10 or 20% upside, but, you don't want to capture everything in this world, right? So from a risk management perspective, I think if you are able to churn rightly, then I think you will have a sustainable performance. I don't think but if you keep a portfolio static, then yes, then there can be trouble.
All right, interesting. You see, one thing which doesn't work for fund managers or mutual fund company is the publicly availability of data. And mutual fund distributors are protected by that. That the mutual fund distributor ने अपने client को क्या return दिया, क्या portfolio churn किया, किसी को नहीं मालूम. So हम लोग बच जाते हैं. मगर आपके data publish होती है. So I wish Motilal all the best, you all the best, because we will see how it works after 6 months, 1 year, 2 year down the line. And if you're able to maintain this top calls, you say that you will churn the portfolio, sell the winners, and you will find new winners in the portfolio. That's a very difficult task. And if you are able to do that, funds will flow. My worry is that the moment funds starts flowing in again and again, you will become big, and then again the alpha will come down. So it's a paradox for a mutual fund distributor or a fund house that if you do well, you will not do well in the future, and if you don't do well, people will not give you money. So it's very difficult. So all the very best to you. Yeah. Any comments? Any comments?
Sir, I think what you said is absolutely correct.
Yeah. So. I want to understand from you the sector call, or if the compliance allows, would you like to speak about your top companies like Tube Investment, Gujarat Gas, or CG Power?
Sure. No, I think
you have them in the portfolio, such large quantity.
Yeah. So I think if you look at some of our top holdings, right, which is say Tube Investments, and I think the reason why we bought it at about $400-500, and it's been a 4x for us already. And we continue to hold that name. Now, why did we buy at the first place, right? We bought the company because there are two things which happened in the company, right? One is there was a management change within the company, right? So Mr. Valayan Subbiah joined the company, when it was about $300-400. And the company is a very old company, but obviously, used to have margin of about 4-5%, right? So I would say slightly more sleepy company, right? And with Mr. Valayan Subaya coming in, I think, our assessment, and I'll kind of highlight one point for us, management is 90%, 10% is everything else, right? Essentially, the guy who really drives the ship is more important for us. So I think that was extremely important for us. And then I think we clearly could see that how many changes that they were doing within the particular segment that they were present, segment after second segment, and line item after line item. So every cost line item, every revenue line item was being attacked very, very aggressively, right? And we could clearly see that this margin of this company from 5% is going to go to 15%. Maybe in the next 3 years, it can go to 4-year period, right? And at that time, when we did our own modeling, we could clearly see that this PE is like some 7 or 8 times, right? Now, when you think about 7, 8 PE over a 2 to 3 year period, assuming your assumptions will go right and the earnings will come through, and then when you look at a group like Murugappa, which is very, very close to what I would say Tatas are, right? Very ethical in some sense, and very focused on growth. Then I think for us the decision making was fairly easy. So that is on a 30,000 feet, right? If you look at from a business model standpoint perspective, there are 2-3 businesses, right? One is the engineering part of the business where they make tubes essentially for the motorcycles, tubes for oil and gas. So auto, non-auto, right? Auto is about 60%, 40 is non-auto. And then they have another business called metal form business, which is essentially, the door panels that they make, the safety parts that they make. So essentially, again, that is auto and non-auto. So about 60% of both these businesses auto. So in some sense, we were depending on the auto sector as such. 2 things happened in these 2 businesses, right? They focused big time on exports, which was 0, right? And export is now 20% of their revenues as far as engineering business is concerned. The cycles business used to be a big loss. And they said that, why are we doing a loss-making business? Let's cut it off, right? And let's focus on the profitable part of the category. So that business also saw a substantial amount of turnaround. Now, when we think about an auto ANC per se, your growth is typically going to be slightly higher than an auto OEM per se, assuming you're gaining new customers, right, at all point of time. Right? If you have a Maruti as a customer, Maruti grows at 4%, you grow at 4%. But if you have a Tata Motor additional next year, your growth will be higher than 4% of Maruti, right? So because you're adding customers who gain market share, which was happening in tube investment. But over and above that, what we really liked about the management is focusing on the electric vehicle category. Now, when we looked at this whole electric vehicle category, right? I mean, look at all the startups and all, and I'm not a very big fan of them. Very, very negative on startup as a category, primarily because of valuations. But I think the management, when we did our work on EV as such, we could clearly see that 2-wheeler EV has no future. I mean, if the consumer is buying a 2-wheeler EV, I think it's like suicidal, right? And maybe he'll realize after 4-year period that the amount of money he invested has actually not yielded him the kind of return that ideally it should be. So here they were focusing on EV 3-wheelers, right? And the reason why 3-wheeler is much more economical because the 3-wheeler runs throughout the day, right? You run much more in a day as compared to a 2-wheeler as such, right? The second thing was what we really liked about their entire thought process is keep on looking at newer areas of growth, which they were. So they've been speaking about medical devices as a category that they want to really get into, right? On a public con call. So I think those are 2-3 things which really excited us. They also have entered into EV tractors. So existing business margins are growing from 5% to 15% with a 20% top line growth, and the new set of seeds of success being born today, which hopefully in the next 3 to 4 years will become very, very large. So we could clearly see a 7 to 8 year runway of very, very, high growth from a high quality company with very high ROEs and, top quality, promoter, and available at 7-8 multiple, right? So it was absolutely a no-brainer as such. And hence, when you buy a company cheap, right, and you don't get a company today on an Excel sheet where a screener will run and give you 8P multiple, it doesn't happen. How well are you able to project the earnings of that company for the next 2 years really differentiates you vis-a-vis someone else, right? So a company with 100 rupee EPS, I can have a view, it will go to 200 rupees. If you have a view, it will not go to 200, it will remain at 100, right? Then the PE for you and me is very, very different for that company, right? From a forward-looking basis. And our decision-making will be completely different. So for us, I think projecting earnings growth for the next 2 is very, very critical. So that we did in tube investment. Gujarat Gas, I think the reason why we bought Gujarat Gas, I think we really liked the way they've managed this entire situation in terms of the spot LNG going up because of Russia-Ukraine crisis. The stock came down from 800 to $500. We could clearly see that, if you look at from an environmental standpoint perspective or an ESG standpoint perspective, I think it's the need of the hour that most of the industrial outlets will essentially move towards natural gas, right, from coal. Second thing, the risk of EV is virtually zero for this company, right? Because they have a very large amount of revenues coming from the Morbi unit, which is tiles, and tiles will not go to the electric route, right? So they have to consume natural gas. A lot of, if you look at the recent court articles, they've been clearly highlighting that should we ban coal permanently and move to natural gas, as an, from an environmental standpoint perspective. And I think that is the way the country is really moving. That's the way the government is thinking. That's the way globally the entire market is getting involved, right? Look at what Europe has announced, that we essentially want to buy a large amount of steel, which will be green steel, right? And so I think globally you will see more of these focus coming on natural gas and moving away from the coal and other fuels, which are essentially generating significant amount of carbon. So we saw that, in the Ukraine-Russia crisis, the spot LNG prices, which is essentially the cost of Gujarat gas, went up from almost $6 to $8 all the way to $40, right? And obviously they had 1 quarter of bad numbers, right? But we could clearly see that in a matter of next 1 or 2 quarters, they will be able to completely pass on, right? And hence, we bought most of our stocks that we bought in Gujarat Gas has been about at 500 rupees, and we were the only buyers. In fact, I didn't realize that we actually became one of the largest buyers, the largest institutional house owning Gujarat Gas, right? Because everyone was selling, we were the only buying. So we, at some point of time, we also used to think, yaar, kuch galat to nahi kar rahe hain. Sab log hi bech rahe hain, hum le rahe hain. So I think, and then, if you look at this quarter earnings, most of them were expecting earnings to be about 450 crores and EBITDA, they reported about 700 crores of EBITDA. So again, pricing power coming to the fore. Generally we are risk averse on PSU, but this is an exception that we did for a PSU, because I think the way the management has really conducted themselves, focus on growth. And I think we clearly believe they're in a sweet spot from a medium to long-term standpoint, given the environmental focus that, Gujarat has. Over and above that, I think the consumption of CNG will really move up. If you look at what Maruti has been highlighting, right? Focus more on hybrid vehicles, which is, focus on CNG or focus on EV as such. I think our view is that PNG and CNG, which is essentially, if you look at the household consumption of gas as well as the consumption of gas within the auto category, I think both of them will really move up. And again, that's a category where the margins are slightly more higher. So we believe that the company, again, same way, right? The company will continue to grow at 15-20% on top line, and we'll continue to see hopefully about, EBITDA moving up by about 50 to 70 basis points from EBITDA per SCM perspective every year. So we're looking at, again, 20-25% kind of a bottom line growth. Again, valuations being very, very low at about close to 20 times on a forward basis. So very comforting on valuations. And again, very, very comfort on growth as such. On a conservative basis, they should do about 25-30%. So that's on Gujarat Gas. And CG Power, essentially, again, it's a category of capital goods. And, India has seen, we all keep talking about whenever there's a budget, the focus has to be on infra. It's a very, motherhood statement, right, that we always keep on making, right? But essentially, if you look at from a data standpoint perspective, we never saw environmental clearances really picking up in a meaningful way, right? We never saw PLI being there in the past 10 years, right? And after COVID, I think the focus on government has really got into Make in India, PLI, and we see so much improvement in environmental clearances which is being given by the government of India, the center government, as well as some of the state governments as such, right? So we believe when we thought about this, we saw ABB, Siemens, and all of that, but we saw that they are at like crazy multiples, right? So we thought that how should one really play this out, right? And we thought that anyone who puts a plant actually needs a motor or a switchgear and so on and so forth. And essentially, this guy will really come in handy, right? So that's how we invested in that name. And I think it was very badly managed company earlier. And, obviously there was a turnaround in making. So again, that's a stock where we made 4x, but we moved, as I said, right, we sold half of it at about $200, right? So we again booked most of our profits. Now, whatever is just free of cost. So,
wonderful.
Yeah. Brijesh, you are breaking.
Last question before we take a couple of questions from the audience.
Yeah.
You see, there's my internet connection. Is it good now?
Yeah, now it's
okay.
fine.
So there's a concept of risk premium that you should invest in debt, and if you go for equity, you should have a risk premium. And generally, that risk premium is set to be 3-4%. Now, in the same manner, there should be a risk premium from large cap to mid cap to small cap.
Yes.
What should be that risk premium? Because large cap at trading, let's say the index is at 25 times. It's a safer category. A mutual fund distributor or an investor, how much money they should put in large cap, mid cap, small cap? This is the first part of the question. The second is that what kind of risk premium one should expect over a 5-year, 10-year premium in terms of alpha. So let's say you get around 10%. Let's say you get 10% in large cap, then what should be the return expectation in the mid cap? And what should be the return expectation in the small cap? This is the second part. And before you answer, I have to highlight one of the research by one of the top AMCs. And they came out with an annual report saying that over 15 years, between 2003 2018 kind of period, the returns from a large cap, mid cap, small cap were almost flat. All three categories almost gave the same kind of returns. On top of it, when I did my research at masterstrokeonline.com, I found that the small cap has delivered 1% or maybe 0.5% more than mid cap over the last 10 years. With that data in perspective, one should not have invested in small cap, taking additional risk, and mid cap should have been better. And the same data is relevant that over 15-year period, there's hardly much difference between large cap and mid cap.
Yes. So I think it's very important that what duration which we really capture. So if you look at a 10-year duration, I think the output, what you said is absolutely right. I looked at a duration since inception. So if you look at since inception, when the index got formulated and all of these three index had similar trend line to start with, right? The returns are slightly in favor of mid caps, right? But anyway, which is point taken. So I think the important point is why small caps has far lower returns. And I would say, for the risk that you take, the return should be disproportionately higher, right? Because the drawdowns are also disproportionately higher, right? But that doesn't happen for small caps. The reason is the index is actually, most of the good small cap companies, right? When they perform very well, they actually get into the mid cap category, right? So the good ones will always move up, right? And hence the mid cap as a category tends to be slightly more richer in terms of quality, right? Also, the small cap per se are very, very sharp on both sides. So if you look at, typically India will see mid cap, small cap rally for 2-3 years, like a tracer bullet, and then sleep down, right? You saw that post demonetization, and you saw that when Prime Minister got elected in 2014, we had a rally and then come off again. So the duration of outperformance or the high growth is generally very narrow, right, for mid caps and small caps. And the drawdown is very, very high in small caps as an index per se, right? So I have always been of the believer that it really depends on which cycle are you at. For example, you would have asked me this question when the market was at 18,500. I would have said, large part of the allocation, about 60% should be to large caps, right? And almost 40% to be mid cap and small cap. Today, I won't say that. Today, with the market correcting more than 20% or close to 20%, I would say that, index being down by about 25 to 30%, I would clearly say that, allocation to mid cap, small cap should be 60% and large cap should be 40%. And as we go down further from here on in the next 1 year or 6 months, and I don't know where the bottom is, we really don't, as a house, we don't focus on predicting where the bottom will be. But our view is that, you might see another 10-15% correction at best, right? In that kind of a situation, you can further allocate more to mid caps and small caps. Now, mid cap in general, from a risk profile perspective, risk to reward ratio is actually sweetly positioned between large caps and small caps, right? Small caps, the reason is the companies are so small that any external shock really impacts them very hard. Large caps, any external shock really doesn't impact them, but any great environment also doesn't really change the unit because the base is very, very high.
Correct.
So that way, mid caps really is both of the best of both the worlds, right? Very, very reasonable base, as well as a company which can absorb shocks in a bad kind of an environment, right? So I would always prefer mid caps over large caps and small caps at all points of time. Personally, 100% of my savings go into mid cap funds. I don't invest anything in small cap and large cap. The only time I invested a bit in small cap was when the COVID part of it happened. But otherwise, largely my focus has always been on mid cap because there is stability, there is high returns, and at some point of time, if the philosophy and the stock selection is much more superior, then the disproportionate returns really kind of come into mid caps, and those returns are much more sustainable. You don't see NAV going to 50 and then going to 25 and back to 75, right? So I think I would prefer mid caps. So at current point of time, I would say that 60% of allocation to be mid caps, and about 40% to small caps and large caps put together.
Fantastic. I think we are running out of time, and I will see if there are a few questions we can take from the audience, and you can also see some of the questions if you like to answer. I will leave it on to you. Would you like to answer the question on Zomato being there in the flexi cap fund? You may prefer not to answer because you're not a flexi cap fund manager. You are a mid cap fund manager. But somebody has asked a question, and you said that probably you're not very fond of startups. So Zomato, somebody is writing. Mr. Venkat Ramana is writing. I would like to know, why Zomato is having allocation in your FlexiCap fund, and even though we know the valuation is high, but I leave it on to you.
Yeah. That's a tough one, right? So I think
Okay.
inherently my view is that startup world, whatever is happening was like more like a circus, right? It's nothing less than a circus, right? And I have so many friends who were analysts in the past, always talking about free cash flow, and when they become a VC guy and all, they talk about hyper growth and all of that, right? And we've generally, you know, there's a small kahawat in Hindi, कि खुशबू नहीं आ सकती कागज के फूलों से, right? So I think, you know, some of these things now suddenly everyone is talking about, you know, getting your unit economics right. And in India, we've generally seen till the time you give free, everyone loves it. The time you take it away, we are so smart that we will also run away, right? So the growth really collapses, right? So I think that was like a riding on the wall, right? So I've been slightly more negative on startups, and that's why I never had a investment in any startups. The only in fact, we had also looked at Zomato so closely, and I could never, in fact, applying the wildest of your imagination, I could never see a company becoming profitable, at least till the time I am and you are alive, to the best of my knowledge and ability. But I think, you know, that market environment was slightly more different. So, and I think the respective fund manager would have a slightly more different way of thinking on it. So for sure, I mean, you know, as a house, we have individual fund managers for every fund, and everyone is entitled to take his or her view on a particular stock or a sector, right? So for me, it's a circus. So I'm like absolutely away from anywhere to invest in startup investing or you know any of these, because I think we do manage unit holders' money.
That's a fair answer.
Yeah.
So I will excuse Niket. You know, there are a few questions on rather than Midcap 30. There are a few questions on FlexiCap, but I would like to excuse Niket because he is managing Midcap 30, and different fund managers have their own style. And probably one day we'll have somebody from Motilal answering on the FlexiCap thing. So Mr. Abrar is asking, and probably you answered that question: how much cash you generally hold in a Midcap fund?
Generally, about 3 to 4%. Nothing more than 3 to 4%. Sometimes when we move out a particular name, or like at 18,000 Nifty or 18,500, when everything was at 50p and we just don't know what to buy, because we knew anything which I buy will just lead to, you know, a drawdown for me. At that time, the cash level went to 12%. With the market correction, we bought it. It's a public domain information. We bought campus shoes recently. So cash has got deployed. We're down to about 3.5%, 4% cash now. So we'll be in the range of 3 to 4% cash, which is in line with what the industry is. But at points of time, if the market goes up dramatically and valuations become expensive, we don't shy away from taking slightly higher cash. But we don't take a cash call as such, because we think index is going to go down. And because even if you take a 10% cash call, index goes down by 20%, you may only make 2%, right? That really doesn't serve the purpose, right? So for us, we don't take cash calls as such. If we get a good idea, we'll buy it. If you don't get a good idea, might as well keep it, you know, keep the bullets with you and, you know, use it at the right time.
That was fantastic, Niket. I thoroughly enjoyed your answers, and I think I got a few answers which I was personally looking at, and I hope the audience found this Q&A good. I will request the audience to stay back for 5 minutes while I will excuse Niket from this. I will have a few discussions of our own. And if you have any feedback, the audience, I would like to please do give a couple of feedbacks in the chat box. How did you like this session with Niket? And if the feedback is good, we will continue to organize such events in the future. And Niket, thank you so much very much. And you were so much open to answer so many questions. Although I did try to ask you some difficult questions which we have as a distributor. And definitely we will become wiser in terms of selection of the mid-cap funds. Thank you so much for being at masterstrokeonline.com platform, and we will engage with you on a later date. Thank you so much.
Thank you so much, Brijesh, for having me here. And I think we have all been very large fan followers of you as well. So really, thank you so much for taking out time and inviting me. We look forward for interacting with you guys in future. Thank you so much.
Thank you so much.
Thanks, everyone. Thanks.
Thank you. All right, so Niket is off. I want you to stay back for 5 minutes. You know, I want a favor from your side.